In the world of investing, few products bridge insurance and securities quite like variable contracts. They sit at the intersection of protection and performance, designed to offer long term growth with a cushion of security underneath. These are the variable annuities and variable life insurance policies, insurance contracts that tie their returns not to a fixed rate, but to the performance of an underlying portfolio of investments. Let's start with the foundation. A traditional fixed annuity promises a guaranteed rate of return. The insurance company takes on all the investment risk. You put in money, they manage it, and they promise a certain payout. A variable annuity, on the other hand, shifts that risk and potential reward to the investor. The money you contribute is placed in one or more separate accounts, which function like mutual funds. Those accounts might hold stocks, bonds, or money market instruments, and the value of your contract will fluctuate with their performance. Now, variable annuities have two distinct phases. The accumulation phase, where the investor contributes money and builds value, and the annuity phase, where that value is converted into a stream of income payments. During the accumulation phase, contributions purchase accumulation units in the separate account. The value of each unit changes daily based on the performance of the underlying investments. When the annuitization begins, that is, when the contract starts paying income, those accumulation units convert into annuity units. The number of annuity units is fixed, but the value of each unit continues to fluctuate, meaning income payments can rise or fall depending on market performance. For the exam, remember this. The insurance company bears the mortality risk, the risk that the annuitant outlives expectations. The investor bears the investment risk, the risk that the underlying investments perform poorly. Because of that investment component, variable annuities are securities. They require both an insurance license and a securities license to sell, typically a Series 6 or Series 7 registration. Now, there are several types of payout options, and they often appear in exam questions. The life annuity provides income for the rest of the annuitant's life, but when that person dies, the payments stop. It offers the highest periodic payment because it carries the most risk for the investor and the least for the insurer. A life annuity with period certain guarantees payments for life, but also for a minimum period, say 10 or 20 years. If the annuitant dies early, payments continue to the beneficiary for the rest of that period. A joint and last survivor annuity covers two people, typically spouses, and continues payments until both have passed away. And a unit refund life annuity guarantees that if the annuitant dies before the total payments equal the original investment, the difference is refunded to the beneficiary. The trade-off is simple. The more protection you add, the lower the payment amount. Variable annuities also carry tax advantages. Earnings grow tax-deferred during the accumulation phase, meaning you don't pay taxes until you withdraw funds. Withdrawals, however, are taxed as ordinary income, not capital gains. And if money is withdrawn before age 59.5, there's a 10% IRS penalty on top of those taxes. Another key rule: while you can move money freely between investment subaccounts within a variable annuity without a tax consequence, once you withdraw it from the annuity altogether, the IRS steps in. The Series 7 exam will often test your understanding of suitability here. Variable annuities are long-term investments, not short-term trading vehicles. They're appropriate for investors who want both insurance protection and growth potential, and who understand that higher returns come with higher risk. They're not suitable for elderly clients seeking immediate income, nor for those who may need to access funds in the near term. Now let's talk about variable life insurance, the cousin of the variable annuity. With a variable life policy, the death benefit and cash value fluctuate based on the performance of the separate account investments. The policyholder allocates premiums among different subaccounts, again, resembling mutual funds. If those investments perform well, the cash value and potential death benefit rise. If they perform poorly, they can fall. However, variable life always maintains a minimum guaranteed death benefit because part of the premium supports a fixed general account. The key difference from universal life, which allows flexible premiums and adjustable death benefits, is that variable life keeps its premium fixed but varies the performance outcome. There's also a hybrid, variable universal life. or VUL. It combines flexible premiums with variable investment options, giving policyholders control over both the cost and performance side of the equation. Now, both variable annuities and variable life policies are considered non qualified contracts, meaning contributions are made with after tax dollars. Only the earnings portion of withdrawals is taxable. They're also not FDIC insured, and their returns are not guaranteed, except for the optional features, like minimum income riders or guaranteed death benefits that insurers may add for an extra fee. For the Series 7, keep these distinctions clear. Fixed annuity, insurance company assumes investment risk. Variable annuity, investor assumes investment risk. Annuity units, value fluctuates during payout. Life only annuity, highest payout, no survivor benefit. Joint and last survivor, payments continue until both annuitants pass away. Variable life policy, fixed premium, variable performance. Variable universal life, flexible premium, variable performance. And one more. Tax deferral doesn't mean tax-free, it means tax later. At their core, these products are about trade-offs, the balance between certainty and potential, between guarantees and growth. They remind us that in finance, as in life, every safety net comes with a price, and every opportunity carries risk. Next time, we'll look at retirement plans and tax-advantaged accounts, how the code shapes incentives for saving, and why understanding those details is crucial not only for the exam, but for every investor's future.